The story that I have to tell, which concerns regulation in the non-financial sector, is nowhere near as scary as Eric should be happy to know. And while I will focus for the most part on non-financial regulation, toward the end I will draw some parallels between the financial sector issues and the non-financial sector regulatory issues that most of my discussion will focus on. So let me begin with some broad brush facts about the U.S. economy, and then talk about the nature of government involvement, which takes, in fact, several different forms. The U.S. is overwhelmingly a market-oriented economy. Government enterprises represent a tiny fraction of economic activity. At the present time, regulated industries account for maybe 3 to 4% of GDP, and so we are, as I said, overwhelmingly on the order of 95% a free market economy. This is much less in the way of government ownership and regulation than in most other developed countries, and it is much less, in fact, than we ourselves have experienced in the past for reasons that I'll start to describe. There are really three different forms of regulatory and governmental involvement in industries generally. One is what we think of conventionally as industry regulation. Second is competition and antitrust policy. And a third involves industries in crises, which is where inevitably we come back and talk a little bit about the financial sector. Not to bore you with principles in intermediate microeconomics, but just to make clear that conventional industry regulation arises generally where free markets would mean monopoly power. And the classic scenario is familiar, I think, to all of you, and that involves a so-called natural monopoly. Natural monopoly description is what I've shown here on this simple graph that shows a downward sloping demand curve intersected by an average cost curve. Those of you who were here for Barry's introduction to free market economics will quickly recall this type of description. And the essential ingredient is that the average cost of a single enterprise producing a product falls throughout the range of normal demand. And as a result, if you were to divide, say, the production into two different entities, the total cost would be higher because each of them would be less than efficient scale. If such an enterprise were allowed to just price and produce as it wishes, it wouldn't give us such a good deal. Think your cable TV company. And what they do is obviously to raise price by contracting quantity. And I've shown here a price above unit cost, above average cost. And the effect of that is to produce a gap between price and cost that is the margin to the company and ultimately to shareholders. So this is the unregulated natural monopoly. This is the standard example that justifies government intervention. Government intervention in industries like this takes the form of controls on prices. And the control on price is the red line shown here, which is the lowest price that can be established while allowing the company to break even. This sets price at average cost, so the total cost equals total revenue and profit equals 0. And by establishing that price, what it also does is to guarantee to consumers that they're not getting ripped off. Now, regulation of industries is a more complicated business than the simple graph shows. One has to account for variable cost, one has to account for capital cost, one has to calculate rate bases and allowed rates of return. And in there lie a great deal of judgment and expertise and differences of opinion between the parties. But at the end of the day, out of the stew comes a representation of the company's unit cost, and that is the benchmark for the price that the company is allowed to charge us. Regulatory techniques have advanced over the years. We now have less of this traditional cost of service regulation and more what's called incentive regulation, where prices are allowed to change or be fixed so as to confront the company with greater incentives to produce more efficiently. that's a separate topic for another class, another day. But we're not imprisoned in exactly the same techniques as were widespread in this country 20 or 40 years ago. Regulated natural monopoly industries that are still with us include local telecom, but not so much long distance, electricity distribution, but not really generation, pipelines. And the reason why long distance and generation are no longer regulated, though they both once were, is that each of them no longer has this high scale property. There are multiple long distance providers, and the lines, of course, are blurred by mobile telephones. Generation is no longer a single electricity producing plant of the size of major metropolitan areas. But of course, local distribution, wires down the street, really represents a continuing natural monopoly. Much of, as I'll describe in a moment, much of the deregulatory movement has been an effort to split apart those places where natural monopolies persist and to allow competition to take root in, say, long distance or electricity generation, where the economic characteristics no longer dictate a single company. As I say here, the nature and degree of regulation has changed over time. We now have right-handed as opposed to heavy-handed regulation, and it also is the case that the degree of regulation varies with the needs of the time. The size of natural monopoly sectors, and as I've described, the emergence of competition shifts certain economic activities from requiring regulation to allowing them to be released into the ordinary market setting. A second form of government intervention, akin to regulation, if not exactly identical to regulation, is antitrust policy. It's viewed by most businesses as regulation, even though many economists would not view it in quite the same light. It's less regulatory because it's more reactive to particular problems. It's not as interventionist as regulation of industries, which digs deep into the operations and accounts of the company. Antitrust basically focuses on three matters: conspiracies and cartels that raise prices. Anyone who bought a flat panel TV or a cathode ray tube or TV or flat panel monitor in the last 10 years may have gotten ensnared in a cartel to which several Asian companies have confessed that they were party to and are now paying damages. Samsung, Sharp, Toshiba, and others have been have pled guilty to price-fixing conspiracies for flat panel display TVs and computer monitors. Conspiracies are a major focus of antitrust policy in this and other countries. Secondly, another focus is the use of monopoly power to deter entry, something that Microsoft was accused of, and more recently, major pharmaceutical companies have been accused of employing so-called reverse payments in order to deter entry. Reverse payments have been used by Shearing and Bayer and other companies to essentially pay off generic manufacturers to delay their generic manufacturers' entry into markets for Cipro and other drugs that are about to come off patent. It's a complicated story. It's been through the courts, and both the Federal Trade Commission and the Justice Department have weighed in on this, but it remains a controversial issue in the law and in economics. And lastly, there, of course, are antitrust policies toward mergers. We have merger guidelines, we have merger enforcement, we have, nonetheless, mergers like AT&T and T-Mobile, which continue to surface and to cause both a lot of public comment and certainly much activity at the Justice Department and the Federal Trade Commission. A third focus, a third type of government intervention into ordinary markets and industries involves crisis policy. Excesses and imbalances that arise in particular markets, in particular industries, and also major transformations and dislocations that require government intervention. S&Ls, which Eric mentioned, airlines after 9/11 received government assistance of a major sort, the auto industry after 2008, and of course the most recent financial crisis itself, all represent, within the last 30 years, episodes of major transformations and dislocations. So let me, with that overview, let me talk a little bit about what I view as cycles of regulation and deregulation that have occurred over time. As I said before, and I'll try to give a couple examples, regulation tends to arise at particular points in time, then it tends to recede for various reasons. As regulation retreats, there's a tendency for imbalances and other events to once again take root, causing another cycle to occur. So going back a little bit before my mandated perspective of the 21st century, in the late 1800s, with the arising of the railroad and national markets, there was much concern over abuses of practices by the large railroads that were formed at that time. And that actually gave rise to the first federal regulatory agency, the Interstate Commerce Commission, in 1890, and also almost simultaneously the first federal antitrust statute in 1887, the Sherman Act. Both of these were major steps on the part of the federal government to take control of situations that represented abusive practices, monopoly power that was otherwise unrestrained. But competition emerged, problems seemed to recede, and there was some retreat of regulatory intervention and government oversight in the following decades. And I would argue that those forces tended to, and the forces that were unleashed by the retreat of regulation tended to cause the next round of excesses and imbalances. The stock market crash and the Great Depression being a very good example, which once again had as a response a whole new wave of government intervention, familiar alphabet soup of federal agencies. Utility abuses led to the Federal Power Commission, telecom monopolies led to the Federal Communications Commission, securities abuses led to the Securities and Exchange Commission, and a host of others as well. So with the growth from the 30s and thereafter of federal regulatory intervention, the fraction of GDP in this country that was subject to substantial government involvement and oversight, regulation in a word, seemed to have crested on the order of 10 to 12%. And that represents really the small fraction of publicly owned activity, public ownership, public enterprise, as well as substantial regulation. As we're all familiar, over the last 40 years, there's been a substantial pushback against regulation, starting with critique of regulation spearheaded by the Chicago School of Economics. The argument was made and really substantially carried the day that the market could better discipline itself than regulation. And in truth, there were many examples, numerous examples, where regulation prevented the emergence of new technologies, where the inefficiencies of the regulatory process had embedded excess costs, limited consumer choice, and generally handicapped the emergence and evolution of new industries and production processes. So there is much to the critique, maybe not quite as much as the Chicago School would have it, but it certainly prompted a useful rethinking of what it was that justifiably should be regulated. So we had, subsequent to that, subsequent to the intellectual critique, policy responded with a series of waves, if you will, of deregulation. And I actually believe that there were identifiably different waves. The first wave was the low-hanging fruit, took care of the low-hanging fruit. Airlines and trucking were examples of industries that most economists and many policymakers were convinced had higher prices than in a deregulated environment. And so deregulating them was a slam dunk, and it produced pretty immediate and visible payoffs to consumers. The harder cases involve things like telecom and railroads, which were attacked or taken on in the 1980s and 1990s. For various technological reasons, this was not quite as easy as the airline example, but it was, in most economists' estimation, largely successful. Generally lower costs and prices, greater consumer choice. Some problems started to emerge. Once again, the S&L crisis was to some degree a reflection of depository institution reform and deregulation, and not everyone was convinced that railroads were a very good example of an industry that would police itself adequately. But still, the cases that were addressed in the 70s, 80s, and 90s were largely, I would argue, successful examples of deregulation. The harder cases, the hard S cases, the frontier, the outer frontier of of substituting competition for regulation, represents industries like electricity, and I would argue banking and financial institutions for somewhat different reasons. Electricity reforms have foundered on the need for finding alternative ways of organizing, coordination, and interconnection between stages of production. Banking and finance deregulation was predicated on good governance and correct incentives and transparency. And there were early signs that these cases might not work so well. There was the electricity crisis that virtually brought California to its knees 10 years ago. There were some spectacular accounting abuses at Enron, at WorldCom, at Tyco. And there was the very alarming canary in the mine shaft of long-term capital management, which collapsed in 1998. And all of this suggested that these cases might not go nearly so well. So the financial crisis of the last 3 or 4 years and the Great Recession swept up, in addition to financial institutions, a number of other sectors. Autos and housing, in particular, were enormously adversely affected. And the result was, once again, government intervention. And I would like to talk a little bit about a couple of cases here, because they give us an opportunity to reflect on the government's role once again, really as crisis management examples. And also I'd like to I will draw attention in a few minutes, to how the latest experience fits into my story about cycles of advancing regulation, followed by retreat, followed by advancement yet again. So let me talk about tale of two bailouts, if you will. Let me talk a little bit about the auto industry, one of the industries that I follow. The problems of the U.S. auto industry predate the financial crisis. This was an industry which only inertia got it as far as it did, and suffered from a whole host of internal problems of management, cost structures, quality, and a host of other things that largely could be tied to the lack of competition amongst the domestic companies. The results were, if you track it over time, this long-term glide path to a much smaller and more impoverished set of companies, with a progressive loss of jobs, market share, profits, shareholder value, you name it. And this went on for many, many years, and that was before the credit crisis and the recession hit. Sales for GM Chrysler Ford dropped by about 50% in the fall of 2008, and this was not sustainable by that or most other companies. So this is an example, as I said, of crisis events which required government intervention. And there was nonetheless a substantial political argument, as all of you I'm sure recall, about the merits, the legitimacy of government intervention in and clearly what was unambiguously a set of private companies that to some degree had made their own mistakes. Free market advocates said, tough. Companies should be allowed to fail, assets would be redeployed to better uses, and this would exact the right penalty for companies that, again, should be punished for their own transgressions. A more pragmatic camp would contend that economic and social consequences of letting that happen would be enormous, that there were regional and social and political consequences, the spillovers onto a host of other industries as well that needed to be factored in. A not particularly interventionist administration, the Bush administration, authorized a substantial amount of interim loans in 2008, basically to hand the hot potato to the next administration. And the Obama administration, quite shortly after taking over in Washington in March of 2009, announced its own auto industry bailout plan, which had several different manifestations involving protection for consumers and suppliers and communities as well, all of which cost, that portion of intervention cost on the order of $35 billion. Not 35 trillion, maybe, but 35 billion still. But that's not really what made the difference. What made the difference is that the government forced the companies into bankruptcy. The government insisted that GM and Chrysler go into bankruptcy because only through bankruptcy would it be possible for the companies to undergo the transformation required. The government took equity positions, and that provided an enormous amount of capital on the order of $50 billion to the two companies collectively. But really what made the difference was the fact that as the bankruptcy courts approved, plants had to be closed, products eliminated. Chrysler was instructed as to how it needed to come out of bankruptcy with a partner. GM was told it would have to cut long-standing divisions to which it had great allegiance, and it did that too. The UAW was forced to confront the fact that it was going to lose jobs and take pay cuts, which they did. Dealers were given the bad news about how many of them would no longer have franchises to sell cars. Bondholders and stockholders and everybody else in sight took a haircut. And most especially, and importantly it seems to me, executives responsible for some of the bad management were removed. The CEOs of GM and Chrysler, who should have been gone a long time earlier, were finally fired. Longtime passive board members were replaced. The companies that came out of that process were transformed. Autos is, as I described here, what I call the hard bailout, not because it was difficult, but because it was a hard-edged bailout. The companies that recovered in the marketplace, and by any reasonable definition, it seems to me, the auto bailout was successful. But it was successful because of the package of things that was done. Not just that the companies were given money, that's in some sense the easy part of it. But the government took firm control of the companies, held people responsible for their actions, transformed the operations of the companies, and then got out. So the institutions were saved because a judgment was made that they deserved or needed to be saved. But at the same time, it was made certain that the responsible individuals did not benefit or even remain on the premises. This is, it seems to me, the hard but good bailout that saves the institutions that you want to save but exacts a penalty for those responsible and doesn't create incentives for future executives to think that the outcome of their inaction or equal incompetence will be a very pleasant one. You see where I'm going, perhaps. I rest my case. There's a soft bailout.
No.
So the crisis of 2008, of course, prompted the need for government intervention elsewhere. And yes, in my view, the banking and financial sector had forces that were unleashed by deregulation there. We can talk about that another time. But the result certainly, no one I think has argued that the crisis was prompted by too much regulation. Let me put it that way. I'm sure I can find some economists who would argue. And it included the largest companies or major players in several different industries. Insurance companies, mortgage companies, banks, hedge funds, you name it. These were huge companies in several different related industries, all of which found themselves on the ropes. So what did and did not happen, it seems to me, is the interesting part of the story. We might have expected, might have hoped, consistent with the actions of the same administration in the auto industry, that they might have stepped in, rescued the companies, which in truth needed to be done, but then to control the bad behavior by reinstating regulation, by restructuring the companies, and by removing responsible people. My 3 R's, if you will. But while the government did step in with massive amounts of taxpayer money, the list of things that did not happen, this seems to me is the alarming part of the story. There was no substantial re-regulation. Every day, every week at least, the newspaper reports are other aspects of Dodd-Frank that are being shipped away. There's no restoration of Glass-Steagall, of a real separation between investment banking and depository banking. And the Volcker Rule, if anyone believed it would be adequate, itself is being written in ways that Paul Volcker says he does no longer recognizes. There's no systematic holding of companies responsible, though I added in my slide here that there was this notable exception of a federal district judge in New York who rejected the SEC settlement with Citigroup as inadequate to the nature of the violations alleged. There certainly is no major breakup of banks. They're now, in fact, larger than they were before, and there's no systematic removal of bad actors. In contrast to other examples, and certainly in contrast to the S&L crisis, people have not been charged with the crimes and misrepresentations that lay at the root of the problem. Banks are now larger than before, and the banking sector is more concentrated than before. Top 10 banks now at 58% of total banking assets. This is more than they did in 2006, more than they did 44% in 2000, and more than twice as much as they had 15 years ago. Top 6 banks, we all can name, have assets totaling 63% of GDP. That was 17% 15 years ago. And in another presentation I made a week or two ago, if you compare this to government revenues, which might be an indication of the capability of the federal government to deploy resources to save these banks, that is even a more depressing story, because in fact, bank assets, top 6 or top 10, now exceed the federal government's resources. And there's no economic evidence that the largest banks need to be so big. And here I'm talking about the top handful. The evidence with respect to the next group is much more ambiguous, I will acknowledge, but there's clear evidence of the systemic risks associated with the largest of banks. And individuals not held fully accountable. The head of Countrywide had to pay $67 million after cashing out, I don't know, somewhere between $400 and $500 million in stock, without admitting guilt as a settlement with the SEC. The head of AIG earned $150 million over 6 years and settled for a fraction of that, again without admitting guilt. The head of Goldman Sachs is still there after earning $54 million, and I might add, said subsequently that he was doing God's work. Remember that quote? So enough of, I don't need to personalize the story, but again, my point is that in contrast to the auto bailout, in contrast to S&Ls, these people have had an extraordinarily soft landing, and they have not been held sufficiently liable. I also should say that I understand that incompetence is not a crime, and that some of it, which was the auto industry, I believe, and the S&L transgressions were much more obviously fraud and embezzlement than some of what has occurred here. So these are not identical. I don't mean to paint this in too simplistic terms. We can talk a little more about what I think could have been and should have been done more recently, if you wish. So, as I said, the incentives for bad bank behavior have really not been controlled. The structure and incentives and even some of the same personnel remain in place. And I believe it's predictable that banks and financial institutions will do this again. And indeed, what else does MF Global experience tell us? Is the canary in the new mine shaft, it would seem to me. In the case of autos, companies and products and leadership was changed. The companies are scarcely recognizable to their pre-bailout form. And this, I think, is the fundamental difference between the hard and soft bailout and the fundamental flaw of the soft bailout. The institutions have been saved. That needed to be done. It was expensive, but it needed to be done. But the behavior, the fundamental incentives of these companies has not been fundamentally altered or constrained. And the regulatory cycle, where tough regulation follows excessive deregulation and imbalances in crises, that regulatory pushback, the advance of regulation, has simply not happened. So what is the proper role of government, as Barry asked me to address, in the 21st century? Well, the picture I have here is a picture of a statue that lives outside the Federal Trade Commission building in Washington, D.C., where I had the privilege of working for 5 or 6 years. The FTC, as you know, is both an antitrust agency. It has joint responsibility for the antitrust laws with the Justice Department, and also a regulatory agency as consumer protection mandate, largely supervision of advertising and some other things. And this statue has been there for some 50 years. The agency's older than that. And the statue is a picture of a rather strong, brawny guy holding back a strong horse, trying to restrain it. What does it imply, and what is it doing in front of the Federal Trade Commission building? It answers the question of what is the proper role of the government in the 21st century, which was the same as the role of the government in the 20th century and in the 19th and 18th. The statute is entitled Man Controlling Trade.